Welcome to the deep dive. You know, trying to keep up with the market news every day, it's a lot.
It really is just a constant flood of information reports, earnings, geopolitical stuff.
Yeah, and figuring out what actually matters. That's the challenge. So today, we're doing the work for you. We're cutting through the noise, diving deep into the DIY Wallst weekly recap and market forecast.
The one for September 7th through the 12th.
That's it. Our goal here is simple. Give you the key insights, the surprising facts, the signals shaping things right now.
So you walk away really clued in.
Exactly.
And this past week, wow, what a week.
Yeah.
Really complex. The source nailed it, calling it plenty of crosscurrents.
Crosscurrents, yeah. Like what?
Well, you had gold just surging, hitting new highs, then bam, jobs data comes in way cooler than expected.
Okay.
And that somehow sparked a bond rally that actually helped stocks, especially by midweek.
Huh. Seems contradictory.
It does. And that's what we need to unpack how these things fit together, or maybe why they don't seem to.
Okay, let's do it. So headline numbers for the week. Kind of a mixed bag, right?
Very mixed. S&P up just a bit, 0.3%.
Dow down slightly, 0.3%.
But the Nasdaq, powered by tech, jumped over 1%.
Right. And the week didn't start strong, did it? There was weakness early on.
Yeah, kicked off feeling a bit shaky. Global bond yields were climbing, especially those long-end yields.
Concerns about government stability, I saw. Europe, Japan.
Exactly. That put some pressure on things initially, but then almost like flipping a switch midweek.
Tech turned it around.
Big time. Those mega-cap tech stocks really pulled the market up.
Interesting. So back to those crosscurrents, what else was moving?
Well, this is where it gets fascinating. Gold, right, the safe haven, hits record highs over $3,500.
Okay, standard risk-off move. Maybe.
You'd think. But at the same time, the U.S. dollar actually got stronger.
Wait, stronger? That's unusual with soaring gold.
Very unusual. And then, throw this in. Crude oil dropped about 3.5%.
Why?
Rumors about OPEC, plus maybe changing production plans.
Yeah.
So you see, gold up, dollar up, oil down.
That is complex. What does that tell us?
It screams market indecision, really. Investors are hedging their bets across different stories. Inflation fears boosting gold, maybe relative U.S. strength supporting the dollar, and potential growth worries hitting oil demand.
So making broad bets is tricky right now.
Extremely tricky. Feels like everyone's watching to see which current wins out.
And then there was that legal news here in the U.S., the Trump tariff power.
Ah, yes. The appeals court ruling against some aspects of those powers.
The source said that added new uncertainty to trade policy. Feels important.
Oh, it's definitely important. This isn't just a news headline. It directly impacts business planning.
How so?
Businesses hate uncertainty, especially trade uncertainty. It makes them pause, rethink supply chains, investment plans.
Right. Predictability is key.
Absolutely. So this legal shift adds another layer of wait and see for companies. It ripples through sentiment and eventually the real economy.
Okay, so while companies are dealing with that, what about the Fed? We heard from Waller.
We did. Fed Governor Waller, typically seen as more dovish, suggested multiple rate cuts are likely. Within 6 months, he said.
And the market's buying it.
Seems so. Futures markets are now pricing in 25 basis point cuts at each of the last 3 FOMC meetings in 2025.
Wow, okay. But there's something else going on underneath, right? This macro rotation.
Yes, this is crucial. Reports from investor conferences are flagging a growing strain, particularly on lower-income consumers.
Where are they seeing that?
Especially hitting the staples sector, things people have to buy.
So essentials are getting tougher for some people to afford.
That's the implication. And it's a really important signal. It suggests that even if the overall economy looks okay on the surface, there's stress building underneath. When those lower-income consumers pull back, it affects everyone eventually.
And that could push the Fed to act faster.
Potentially, yes. It might shift their focus more toward supporting growth, not just fighting inflation. It shows the economic picture isn't uniform.
Okay, let's dive deeper into that economic data, specifically the labor market. It cooled off significantly.
It really did. The evidence was pretty broad-based.
Like the JOLTS report?
Yep, the JOLTS vacancies to unemployed ratio, it dipped below 1. First time since early 2021.
Meaning fewer jobs open than people looking.
Exactly, a much less tight labor market. And then the big one, the August payrolls report, NFP,
How did that look?
came in really weak. Only 22,000 new jobs added. 22,000.
Wow, that is low.
And it wasn't just the headline number. Unemployment ticked up, wage growth slowed down, even weekly hours fell.
So multiple signs of cooling.
Across the board. ADP's private payrolls showed similar weakness. ISM surveys, challenger job cuts, even the Fed's own beige book. They all pointed to a slowdown.
It sounds almost coordinated. Was anything positive in there?
There was one key positive.
Yeah.
Productivity. It actually surged. Fastest pace in nearly 2 years.
Okay, so less hiring, slower wage growth.
Right.
But higher productivity. What does that mean for costs?
That's the key insight. Higher productivity means businesses get more output per worker. Combine that with cooling labor demand.
And it puts the brakes on labor costs.
Precisely. It reduces inflationary pressure coming from wages. And market takeaway was pretty clear.
September rate cut.
Locked it in, basically. Our source even said some analysts were arguing for a 50 basis point cut.
50? Really?
Yeah, if it weren't for those tariff uncertainties we talked about.
The tariff overhang acting as a constraint.
It raises that question, doesn't it?
Yeah.
How much is external policy stuff holding the Fed back from doing what the domestic data suggests?
Interesting point. Okay, let's shift to the corporate side. How did these crosscurrents hit individual companies? Tech first.
Tech was, well, a story of contrasts. Big relief rally for Google, right? The judge didn't order a breakup of its search business.
Yeah, huge news for them.
And Broadcom just crushed expectations. Q3 was stellar. AI revenue up, 63%?
Massive jump. And CEO Hocktan is staying on too.
Right, another 5 years. So clearly, massive investment is still pouring into AI, even with broader jitters. Another crosscurrent right there within tech itself.
But not all tech giants had such smooth sailing.
No, it was more nuanced elsewhere. Nvidia, for instance, denied rumors about big GPU production cuts.
But the stock still drifted lower.
Yeah, maybe some profit-taking, maybe just lingering unease. And Salesforce had solid results, technically. But their guidance, their look ahead, was cautious. And that seemed to weigh more heavily on the stock than the actual earnings beat.
Shows how forward-looking that sector is. Okay, what about retail?
Retail really showed those macro pressures. You had American Eagle and Macy's posting strong quarters, which sounds good.
Yeah.
But then both explicitly warned that tariffs are going to hurt them later this year.
There are those tariffs again.
And then Lululemon beat on earnings per share, but then slashed their guidance.
Why? Let me guess. Weak U.S. demand and tariffs.
Bingo.
Yeah.
Weak U.S. demand and tariff headwinds. It connects directly back to that consumer strain and the trade policy uncertainty.
So these aren't abstract economic forces. They're hitting companies' bottom lines and outlooks.
Absolutely. It's a clear illustration of how macro plays out on the micro level.
And it wasn't just retail feeling the pinch. Energy and industrials, too.
Right. So headlines about Halliburton planning job cuts, ConocoPhillips looking at potentially significant workforce reductions by 2026, maybe up to 25%.
Wow.
And Caterpillar also explicitly mentioned worsening tariff pressure hitting their profitability.
Tariffs just keep popping up everywhere.
It's a recurring theme, definitely. But amidst all that, there was still some M&A action.
Oh.
Air Lease, Lilly Yields being taken private. Big deal, $28 billion, PE-led, includes debt.
So money is still moving, deals are happening in some corners.
Exactly. Shows that even with headwinds, some areas are seen as having long-term value, attracting significant investment. Another layer to the complexity.
Okay, let's pivot to the week ahead, September 8th to 12th. What's on the economic calendar?
Key inflation data is front and center. We get PPI, the Producer Price Index, on Wednesday. And then the big one, CPI, on Thursday.
That's right, Consumer Price Index on Thursday. Highly anticipated. Then Friday, we get Michigan consumer sentiment and expectations.
Plus things like consumer credit, jobless claims.
Yeah, the usual flow. But the really critical context for this week...
Fed blackout, period.
Exactly. The Fed goes silent ahead of their meeting on the 16th and 17th. No speeches, no hints.
So markets will be purely data dependent, reading the tea leaves from PPI and CPI.
Even more intensely than usual, trying to guess the Fed's move without any direct guidance.
So what's the market forecast looking like for this week? SPX.
The source suggests things might calm down a bit, maybe somewhat bullish.
Why bullish if the Fed is silent?
Well, the lack of Fed talk means fewer potential negative catalysts, maybe. Plus, the expectation of cuts is still baked in. Resistance levels mentioned are $6,540 and $6,600.
And support.
$6,422 and $6,277. Weekly sentiment is noted as a bullish cross-up, so some positive momentum technically.
Okay, what about the dollar, the DXY? The US dollar index. Chart-wise, they see a descending triangle.
Which suggests...
likely heading lower, especially with rate cuts expected, which typically weakens a currency. Resistance seen at $98.75, support at $97.45.
Sentiment there.
Mixed. Reflects that uncertainty we talked about, relative strength versus rate cuts.
Got it. And the fear and greed index?
Slipped back. Moved from greed down to neutral, sitting around 53.
And put call ratio?
Eased off. The 5-day ratio came down from last week's spike. Suggests maybe less aggressive hedging or bearish betting.
So neutral sentiment. What's the takeaway there?
It implies the market isn't overly fearful, but it's not wildly exuberant either. As Baya's note and the source pointed out, bonds have slightly outperformed stocks recently, adding a touch of caution.
Okay.
So it feels like a market that's waiting, watching the data, weighing the Fed, maybe a bit defensive despite the rate cut hopes.
And quickly, Bitcoin, BTC.
The forecast there is pretty straightforward. Expectation is for digital gold to rise as the actual dollar potentially weakens due to rate cuts. Major resistance noted way up at 125K.
All right. Now, the source also mentioned a few specific stock picks for the week.
Yes, quickly highlighted Marqeta, MQ, Robinhood, HID, and Oracle, ORCL.
Just remind us what they do.
Sure. Marqeta's in digital payments, card issuing tech, Robinhood, obviously the retail trading platform for stocks, ETFs, crypto, and Oracle, the database and cloud giant.
And the source gave specific trading levels.
Yeah, buy, sell, stop loss points were provided for context on their strategy for those names this week.
Good context. And, we've thrown around terms like support, resistance, SPX, maybe a quick definition refresher.
Good idea.
That's
So
great.
a support, think of it as a price floor, a level where buying interest is usually strong enough to stop a stock from falling further, at least temporarily.
Okay, a safety net.
Kind of. And resistance is the opposite of price ceiling, a level where selling pressure tends to emerge and stop a stock from rising further.
Got it. And SPX.
That's just the ticker for the S&P 500 index, the big benchmark for the U.S. stock market, tracking 500 large U.S. companies.
Perfect. Okay, so let's try to wrap this all up. We've covered a lot. Cooling labor, likely Fed cuts, nagging tariff issues, consumer strain, mixed corporate signals.
A really tangled web.
So what's the main thing for people to take away from all this complexity?
I think the key is understanding the connections. It's not just one thing. It's how the labor data impacts consumer spending, which impacts retail warnings about tariffs, which all feeds back into what the Fed might do.
Seeing the whole picture.
Exactly. Recognizing these different forces, even when they seem to contradict each other, is crucial. It's about appreciating the dynamic interplay, not searching for one simple answer.
Makes sense. And the source left us with a really interesting question to chew on.
The question of the week.
Yeah. With payrolls collapsing and the Fed poised to cut, do you think they should move 25 basis points in September or go bold with 50 basis points?
Ooh, that's a good one. The steady hand versus the decisive move.
Right. Do they ease in gently or try to get ahead of potential weakness more aggressively? Lots to think about there.
Definitely food for thought.
Well, thank you for joining us on this deep dive, navigating these market crosscurrents and the Fed's upcoming decisions. We hope it's given you a clearer perspective.
Hope it helps you make sense of the week ahead.
Keep exploring, keep questioning. We'll see you next time on The Deep Dive.